when the facts change, I change with them. What do you do, dear sir? It's obviously I haven't changed my bullish view all the way through, but people get upset because I've been talking about a bust for 5 or 6 years, and they go, yeah, well, you called a bust 6 years ago, you've been wrong. And I said, no, I've been bullish the whole time. It's the bust follows the end of the bull market. What will cause it? Obviously nobody knows for sure, but it's usually some sort of misstep in Fed policy. So they might tighten when they should be easing, or they may not ease enough, or they might not recognize the need for more liquidity. Obviously, if you get a very bad inflation story, and not for a month or two, but if that were to continue, if things went wrong in Iran and oil went to 150, those kind of things can really turn the economy down, and the markets would react ahead of that, or at least react pretty quickly to signs that that's going to come. As I say, the reason I'm calling for something bigger than just a normal recession, something that I call a global bust, is because of leverage. We have far more leverage today in the system than we had in 2008-9, and that was off the charts then. So 2008-9 happened because of the leverage, or it was far worse than it would have been otherwise because of leverage. And this time we're far beyond the leverage we had then. And I define leverage as the debt obviously is leverage on the financial system, on the economy, and derivatives are leverage on the markets. And we've been, really since the 80s, been creating all these derivative products that are now mainstream in retail as well as institutional. And it's that leverage both on the debt side and both on the credit side and on the equity side. There's just all kinds of leverage in derivatives, so that when this thing does turn down, that leverage, both debt and derivatives, exacerbates the downturn. So what kind of enhances on the upside, options and margin, if you're right, that can really give you the chance to make more money. But when things turn down, that leverage really exacerbates the downturn. So I think that's the biggest reason for something worse than just a plain ordinary recession that we have every number of years, because things go to excess in the economy and in credit markets, and they just get corrected. So I've been a follower of the Fed since I entered this business in 1973. And the one thing I can say with assurity is that Feds lag, policy lags, so it's almost guaranteed that they're at one time or another going to misstep. And that plus the fact that when the reason you get to ends of cycles is because of excesses and imbalances. In 2008-9, it was subprime, among other things. Now it might be private credit. Certainly private equity is very leveraged. People get over their skis in terms of bullishness and exaggerate what, they kind of extrapolate what's happening now and think it can go on forever. Ultimately, I think 2008-9 almost guarantees that the Fed is not going to do that this time, at least on a timely basis, because you heard Jay Powell say it several years in his reign.
This is where David Hunter makes his boldest prediction. He isn't warning about an ordinary recession. He's warning about what he calls a global bust. According to him, today's financial system carries even more leverage than it did before the 2008 financial crisis. If a major shock hits the system, that leverage could amplify losses across markets. While this is his personal forecast, not a certainty, it highlights why investors should pay close attention to risk management during periods of extreme optimism.
The economy is still surprisingly intact. I have always talked about a have and have not economy. Some people call it a K-shaped economy. And I think that's still the issue, is that half the population doesn't feel like we're in a booming economy at all, probably more than half. And frankly, we are seeing signs that things are moving towards a recession. We're not there yet, I don't think. I know there are a few people out there are saying that, based on some numbers, you could argue we're in recession now, but I think we're moving that way. The economy's slowing, but amazingly, it's still intact. You could have made these same comments a year ago, and it's still kind of pushing along. But I do think as we get closer to the end of this year, we could be in a recession, and if not, very close. Manufacturing, because of the reshoring and all that's going on with AI, that's really holding the economy up, and that side of things looks really good, as you might see in some of the industrial stocks, et cetera. But it's the other, the consumer, half the consumer really is struggling. Amazingly, consumption's still fine, but you are seeing signs they're having to pull more out of savings to keep their shop till you drop spending going, and that's obviously can't be sustained. So jobs are slowing, but every time you think they're really going to start giving you bad numbers, they kind of pull themselves back up. So we're just kind of, I don't want to say steady as we go, but we're skating along here in positive territory on the economy side. The markets, I am as bullish as ever. I do think it comes to an end, maybe before the end of this year, but right now, my numbers are, if you go to my targets, you're still looking at more than 30% upside in all the indexes, all the four indexes I target. So, Dow, I just raised my target in my July letter to 10,000. I had been at no, I'm sorry, not 10,000, 70,000. I had been at 67,000. My S&P number is 10,000, and I didn't raise that one this time, but I'm at 10 there. I'd raised it in early June. I'm at 36,000 on the NASDAQ and raised that in early June, and I'm at 4,000 on the Russell. And, for a long time, I got beat up for my Russell bullishness because it lagged the others, but it has certainly caught up this year, and I think still has good upside ahead. So what I see out there is really, I think the next few months are going to be really strong. Whether this takes, I get people on X constantly wanting me to tell them what time it's going to top, and I say it can happen very quickly because I think we're in a parabolic. If you look at the monthlies on the charts, you can still argue, in spite of June consolidation, you can still argue that it looks very vertical here and that it's going to just get steeper from here. So if that's the case, if we don't go through a long drawn out consolidation, you can get to those numbers, believe it or not, within a few months. But if it takes longer, it takes longer.
David Hunter believes we're in the final stage of a massive bull market. While many investors expect a recession immediately, he argues the market could first surge another 30 to 40%, pulling even more people in with fear of missing out. History shows that the strongest optimism often appears right before major market reversals. If his outlook proves correct, this rally could become one of the biggest bull traps we've seen in years.
I think we're going to actually see that, but it's going to come at a time when the economy is in the dump. And, so people who today say they'll buy when rates get down, or, feel like they have to wait for rates to be lower. When that happens, even if they want to buy, they may not have access to credit because the banks are going to be much more stringent. Mm-hmm. And secondly, they may have lost their job. They may not feel secure in their job. So it's a bad economy, and low interest rates is not conducive to a better housing market. I think we're peaking in housing. Can it bounce as rates, because I do think rates are going to roll over here. Can it bounce for a few months as rates come down and you get you saw that early in the spring, when rates turned down for a little bit, you had some pent up demand that said, oh, I better jump now because rates are down a half a point or a point. But then the war hit and rates went right back up. But I think we're at a peak in housing, and going forward, it's going to be hard to exceed the price levels we're seeing. Obviously, different regions are in different places, but I think the highs in prices this cycle may not be seen again next cycle, because of a different economy, and I think the consumer is going to get hit pretty hard in the downturn. I'm predicting, whether it'll happen or not, something like a 70 or 80% bear market in the global bust. If you get the combination of that and say a 30 to 40% hit to housing prices, the whole wealth effect is huge, and you don't come back out of that quickly. So even if rates fall to what I expect them to fall to because of the bust, even if rates go to, I think the 10-year can go to zero in the bust, and then be slow to come out of, from those lows for the first year or two. So in the recovery following the bust, even if mortgage rates are, 2.5 or 3%, it's going to be very hard to see very many people that are in a place to buy homes, either psychologically or financially.
Many investors assume the Federal Reserve will always step in to rescue the markets. David Hunter disagrees. He believes policymakers may hesitate to act quickly, allowing financial conditions to deteriorate further. That's why he warns of severe downside risks for both stocks and housing. Whether his prediction plays out or not, his message is clear. Investors shouldn't rely solely on central banks and should always have a plan for managing risk.
Before we go to gold, the IPO thing is a troubling sign because it's demanding a lot of capital that's got to come from somewhere.
Yep.
I mean, I have long argued that everybody would look and say, well, the Fed's, raising rates or money's not flowing right now. Where's the liquidity that's going to drive your bullish market forecast? And I said, the institutional investor has been skeptical from the bottom in 1982 all the way up. They first, it was a bear market rally. Then, okay, it went to new highs. I guess we got to jump on a little bit. But they kept their, even now, most of them their targets are right near where we are. A few have raised them towards 8,000. But, so there's been a wall of worry. There's been a skepticism. That means there is liquidity that can fuel this. But it does become concerning when you have a SpaceX that demands as much capital as that did. And there's other AI companies obviously coming behind them. So at some point, yeah, it does, the pot of money isn't infinite. So that can be another issue as we move towards this top. But we're not there yet. I just think there's enough signs that this thing has some legs. And I think that's what's holding this market back, is that kind of concern that, people have enough things out there that they can be bearish on if they want to. And certainly that question about liquidity is one of them. So gold, I'm equally bullish on gold and silver. We had that great run from November to January in silver, and gold was a longer run than that. But silver got up to 122 from it had been in the 50 area when it broke out. It was a long-term breakout point. There's 48 or 50, and it just took off and basically went parabolic. More than doubling in probably 150% in 3 months. And so people are you had to correct what was speculative blow off. People were just through the roof in bullishness, and you had to correct that. I thought it'd correct in a few months, but it's taken 5.5 months now. And you've gotten a lot of that speculation out of there. Certainly a lot of people who jumped in the last inning of that run. They weren't there at 50. They weren't there at 75. They might have gotten there over 100. And all of a sudden they're down in half almost, and so that wakes you up in a hurry and turns you bearish in a hurry. So I think we have the sentiment there now, the backdrop and sentiment there now, where we can come out of this. And I believe normally I'd say a parabolic usually comes at the end of a move, at the end of a big cycle move. But in this case, it was so fast and it unwound so fast that I think there's even a steeper move following that. So if you can do that in 3 months, you can see another, my target on gold is 7,000. My target on silver now is 200. So particularly silver, being where it is down just under 60, if it can go from 60 to 200 this year, and maybe even faster than the end of the year, that's pretty steep. And gold, obviously, if it can go from 4,000 to 7,000, would be an unbelievable move. So that's what I'm seeing, and that's what I expect. I realize there's lots of people out there in that field, people that follow gold and silver closely, who think they both have more to go. The breakout in silver was 50. Gold looks like it could go back 3,500. And so I can't say that's impossible, certainly, until this thing really gets turned around and you start seeing a little more upside. There's always a risk that, this is just another dead cat bounce and it goes lower. I think, based on what I see in sentiment and what I see in the charts and everything, there's a pretty good chance we came down to a trend line on silver, and gold looks like 4,000 or 3,900 is a pretty good place. And ironically, and I didn't do it for this reason, but if my numbers, and my numbers may not be right, but if my numbers are right, 200 on silver to get back down to 50 would be about 75%, and it would be exactly 75%. That would be, kind of a normal if I'm right about what equities are going to do and what we're heading for in terms of global bust. Silver is a very cyclical metal, and it will get hit almost as hard as equities. 75% would make sense to me. That would take you back to that 50 breakout point that all these technicians think is necessary to get going. So you could have it, but not have it now and have it later. Got down to 56 in this correction. Gold from 7,000 to 3,500 is 50%. 50% retracement would be a very normal retracement in anything, but in gold, certainly that would make sense. So whether those numbers are right or not, I didn't get to my numbers that way, but the other day I just said, those are convenient, kind of places where it could correct from. So I think the possibility is that all those people waiting here for that last shoe to drop, as often the market doesn't accommodate, you take off from here and you get to those breakouts, those natural places where it should go down to in the bust rather than now.
David Hunter believes the recent correction in gold and silver has removed much of the speculative excess from the market. Because of that, he expects another powerful move higher, with long-term targets of $7,000 for gold and $200 for silver. These are his personal projections, not guaranteed outcomes, but they certainly explain why many investors continue watching the precious metals market closely.